Ever wondered how bonds can be a low-risk way to grow your wealth? Imagine lending money to a friend or family member. They promise to pay you back with a little extra for the favor. Bonds work in a similar way, but instead of lending to individuals, you lend to governments or corporations. These entities need money for various reasons: building roads, expanding operations, or funding new projects. Bonds are essentially IOUs issued by these entities to raise capital. When you buy a bond, you're essentially lending them money. In return, they promise to pay you back the principal amount, the original amount you lent, at a predetermined date called the maturity date. Think of it as a loan with a set repayment schedule, but here's the beauty of bonds. You don't just get your principal back, you also receive regular interest payments known as coupon payments for lending your money. These payments are typically made semi-annually and are a key attraction for bond investors. Bonds offer a level of predictability and stability that can be quite appealing, especially in uncertain economic times. In essence, bonds represent a contractual agreement between the issuer, the borrower, and the bondholder, the lender, outlining the terms of the loan, including the interest rate, payment schedule, and maturity date. This makes bonds a relatively low-risk investment option compared to stocks, offering a predictable income stream and the return of your principal investment upon maturity. The world of investing often presents us with a fundamental choice: stocks or bonds. While both offer avenues for growing your wealth, they operate quite differently and carry distinct risk-reward profiles. Understanding these differences is crucial for making informed investment decisions that align with your financial goals and risk tolerance. Stocks, often referred to as equities, represent ownership shares in publicly traded companies. When you buy a stock, you're essentially buying a small slice of that company. The value of your investment fluctuates with the company's performance and the overall stock market. Stocks have the potential for high returns, but they also come with a higher level of risk. Bonds, on the other hand, are debt securities. When you buy a bond, you're lending money to an issuer, and they promise to pay you back with interest. The interest payments are fixed, providing a predictable income stream. Bonds are generally considered less risky than stocks, especially over shorter time horizons. Think of stocks as race cars. They offer the potential for speed and excitement, but they also come with a higher risk of crashes. Bonds, in contrast, are like reliable sedans. They offer a smoother ride with less volatility, making them suitable for more conservative investors or those seeking a steady income stream. The key is to find the right balance between risk and reward that aligns with your individual investment goals and time horizon. One of the most appealing aspects of bonds is their ability to generate a predictable income stream through fixed interest payments, often referred to as coupon payments. Unlike stocks, where dividends are variable and not guaranteed, bondholders receive these fixed payments at regular intervals, typically semi-annually, for the duration of the bond's term. The coupon rate, expressed as a percentage of the bond's face value, determines the amount of each interest payment. For instance, a bond with a face value of $1,000 and a coupon rate of 5% will pay $50 in annual interest. This fixed income stream makes bonds an attractive option for investors seeking a reliable source of passive income, such as retirees or those nearing retirement. However, it's important to note that the coupon rate is only one factor influencing a bond's potential return. The price you pay for a bond, which may be higher or lower than its face value, also plays a crucial role. This is because bond prices and interest rates have an inverse relationship. When interest rates rise, the prices of existing bonds fall, and vice versa. Understanding this interplay between interest rates and bond prices is essential for maximizing your returns and managing your risk. By carefully considering the coupon rate, maturity date, and current market interest rates, you can make informed decisions about which bonds to buy or sell and when to optimize your bond investment strategy. The world of bonds, while generally considered more stable than the stock market, is not without its own dynamics. One of the key factors influencing bond prices is the movement of interest rates. Understanding this inverse relationship between interest rates and bond prices is essential. If interest rates rise, new bonds offer higher rates, making existing bonds less attractive. To entice buyers, the price of your bond will drop below its face value. Conversely, if rates fall, your bond becomes more attractive and its price will rise. Stay informed about interest rate trends to make strategic decisions in the bond market. Why bonds belong in your portfolio: safety, stability, and diversification. In the realm of investing, diversification is often hailed as the closest thing to a free lunch. It's a strategy that involves spreading your investments across different asset classes such as stocks, bonds, and real estate to reduce overall portfolio risk. Bonds, with their relatively lower volatility and potential for stable income, play a crucial role in achieving a well-diversified investment portfolio. While stocks offer the allure of potentially high returns, they also come with inherent volatility, which can be unsettling for some investors, especially those approaching retirement or seeking to preserve capital. Bonds, on the other hand, provide a cushion against market swings, acting as a stabilizing force within a diversified portfolio. Consider bonds as the ballast in a ship. Just as ballast helps a ship maintain stability during rough seas, bonds help stabilize your portfolio during turbulent market conditions. When stock prices plummet, bond prices tend to hold steadier, mitigating overall portfolio losses. Moreover, bonds can be particularly beneficial for investors seeking a regular income stream, such as retirees or those nearing retirement. The fixed interest payments provided by bonds can supplement other sources of income, providing a sense of financial security. By incorporating bonds into your investment strategy, you can potentially reduce overall portfolio volatility, preserve capital, and generate a predictable income stream, making bonds a valuable component of a well-rounded investment plan. Taking the plunge, your guide to investing in bonds. Navigating the world of bond investing might seem daunting, but it's more accessible than you think. With a bit of knowledge, you can confidently incorporate bonds into your portfolio. Here's a practical guide to get you started. First, determine your investment goals and risk tolerance. Second, choose the right bond type. Government bonds are the safest but offer lower yields. Corporate bonds carry higher risks but offer potentially higher returns. Third, explore bond funds for diversification. Fourth, consider maturity dates. Finally, consult a financial advisor for personalized guidance. Bonds in the grand scheme. Comparing bonds to other investment avenues. Understanding where bonds fit within the broader investment landscape is crucial for creating a well-rounded and diversified portfolio tailored to your specific financial goals and risk tolerance. Let's compare bonds to other common investment avenues. Stocks. As we've discussed, stocks represent ownership shares in publicly traded companies. They offer the potential for higher returns than bonds, but also come with higher volatility and risk. Stocks are generally more suitable for long-term growth, while bonds provide stability and income. Real estate. Investing in real estate involves purchasing physical properties such as residential homes, commercial buildings, or land. Real estate can generate rental income and appreciate in value over time, but it's also illiquid and requires significant capital outlay. Real estate can complement a portfolio that includes stocks and bonds. Commodities. Commodities are raw materials like oil, gold, and agricultural products. Commodity prices fluctuate based on supply and demand, making them a volatile investment class. Investors often use commodities as a hedge against inflation, but they don't generate income like bonds, cash and cash equivalents. This category includes savings accounts, money market accounts, and short-term certificates of deposit or CDs. These options offer high liquidity and safety of principal, but typically yield lower returns than bonds or stocks. The key takeaway is that no single asset class is inherently superior. The optimal mix of stocks, bonds, real estate, and other investments depends on your individual circumstances, risk tolerance, and investment goals. A well-diversified portfolio strategically allocates assets across different classes to mitigate risk and enhance potential returns. The last word: bonds, a prudent path to financial growth. In conclusion, bonds serve as a vital instrument in the realm of investing, offering a unique blend of stability, income generation, and diversification benefits. Whether you're seeking to preserve capital, generate a predictable income stream, or simply reduce overall portfolio volatility, bonds deserve a place in your investment strategy. By understanding the fundamental principles of bond investing, including the relationship between interest rates and bond prices, the importance of diversification, and the various types of bonds available, you can make informed decisions about incorporating bonds into your portfolio. Remember, bond investing, like any investment strategy, requires careful consideration of your individual financial goals, risk tolerance, and time horizon. Before making any investment decisions, it's always advisable to consult with a qualified financial advisor who can provide personalized guidance tailored to your unique circumstances. A financial advisor can help you navigate the complexities of bond investing, ensure your portfolio aligns with your financial aspirations, and guide you towards a secure and prosperous financial future.